Let's bring on board then Sandeep Bhatia, the MD and Head of Equity India at Macquarie Securities Group. He joins us in the show right now. Sandeep, hi, good morning. One wonders what's adding to the weakness or nervousness in the market. Is it just geopolitical tensions, or do you think India per se is also falling under its own weight of maybe rich valuations?
So this is, the month of August. We have gone through results season. There's nothing much now in terms of news flow to look forward to. The big news flow will probably happen post the September quarter. We would have the final outcome of the monsoon very clear. Of course, that would be on the whole a good outcome as far as the monsoon is concerned. But more importantly, I think we will go into the Diwali busy season after September, and that will be critical. Not only that we expect some rate cuts to happen, we would think a 25 basis point rate cut could come through in the next RBI meeting also. But more importantly, I think we will see the first push coming through from consumption post the monsoon. So I think in this near term, the market should be range bound, and every weakness is an opportunity to buy.
Sandeep, ultimately stock markets reflect the state of earnings, and we may be in a great macro positioning, but earnings are not there. And each time we interact with global heads of brokerages, they remain optimistic. So do you think somewhere we need to hunker down our earning expectations, because the kind of sound bites we've got from SBI, BOB, all of them are indicating to a very weak corporate cycle?
I think there's been weakness for the last 3 years. There's been weakness for even longer than 3 years. Now, the question is, how long is the waiting game? I think that's what is the essence of the question that is being asked right now. I think the waiting game is getting over. If you look at the macro growth numbers, not only for India, but in fact, IMF has revised China's GDP growth rates for the current year. Both Europe and US, in that order, have surprised positively compared to expectations. So global growth has broadly moved ahead of what people were expecting at the beginning of this year for 2017. As far as India is concerned, India's macro position has consolidated this year, and clearly we are in a position to see strong pickup in growth coming through. The earnings growth question will get answered. I think the next quarter is the quarter when we will see the meaningful earnings surprises come through for consumption stories. As far as the public sector banks that you have directly asked, I don't think there we will see a positive earnings surprise for the next 1 year at least. But there is a dichotomy between earnings and prices, and in fact prices move ahead of expectations most of the times to earnings. And when earnings are peaking, that's when prices should logically be already falling. So right now we are not in the phase where earnings are peaking in any sort. So I would say it's a range bound to flat market, but still a buying opportunity at every dip. Your question on earnings growth will get answered first by the consumer stories in the next quarter, and by the broader market also by next year.
So what does one do in the interim? We are up 20%. And globally, there is a mild degree of profit booking which has kicked in. Do you think before earnings recovery kicks in, we could be in for a sharpish kind of a correction?
By sharpish, if you mean more than 10%, no. By sharpish, if you mean maybe 5%, that is something which is always possible. A 400 to 500 point correction could happen from here onwards. But that would be a correction I would buy into. As far as sectors that will perform in the near term, I think the financials will continue to drive this. If you are comfortable, then you should not only look at banks such as HDFC Bank or Yes Bank that we like. We could look also at larger private sector banks such as ICICI Bank, which will also benefit. We also like HDFC Limited. We see both rebound coming through housing finance for HDFC and lower rates also helping the outlook on housing finance growth. So all this, so the financials is one sector definitely. You could look at a rebound coming through in consumption. So Hindustan Unilever is definitely looking good. Hero MotoCorp looks good. Even in the metal space, we like base metals. So Vedanta definitely and Hindalco both look good.
Now, you've been bullish on metals and you've been ahead of the curve. But what is the construct for metals? Metals is more like a global play. You cannot be bullish on India and be bullish on metals. If you're bullish on metals, which means you are very constructive either about the demand supply equation for metals, or you expect great economic recovery.
So China is the metals story of the globe, and Chinese growth has surprised on the upside. As far as the metal story is concerned, our view is that stick with competitive players in the Indian space, which are, as we have identified, Vedanta and Hindalco. In the steel space, we expect price correction to come through for steel demand and steel prices in the later part of the year. And to that extent, in near term, steel stocks may perform well, but there could be pressures coming through. Sorry, I'm just
catch your breath, have a sip of water. We'll just come right back to you. Okay, in the meantime, let's just check in on what else the market is up to. And, we've been highlighting as to how Biocon is another stock which is in focus. And I just want to bring that stock up for you on your screens. Biocon is, of course, is one stock which is in focus. Let's just get back to Biocon right now. And we've been highlighting as to how Tata Global Beverages is the other one which is holding out very well. Biocon, of course, on that HSBC note, Biocon, as stand corrected, is a loser today. And Adani as well. Remember, there was the Guardian report. So both of these stocks are some of the biggest losers within the F&O markets. What else is actually putting pressure and what's really turning around? It's got to be the banks. Just look at the speed at which the market breadth has completely changed hands. And it's favoring the declines by a huge margin now. So what looked like a very positive start to trade for the broader markets is completely reversed trend. We're now standing at 144 stocks within the F&O markets on the declines to just about 63 to the advances. Adani Enterprises, Biocon, Jindal Steel, Arcom, GSFC. These are your big losers. From within the Nifty, it's largely banks, SBI, ICICI Bank, Yes Bank, BOB. They're all laggards. L&T is your top loser within the Nifty. ONGC as well is adding pressure. You've also got some of these pharmaceutical names which were really holding out in Monday's session. They're reversing trend. So Cipla, DRL, these are all some of the other names which have reversed trend. Lupin as well being the other one. And then Reliance as well is dragging down. That's down about 1.25% right now. Sandeep, hope you've managed to catch a sip of water. But what would you buy when the market does correct by about 0.5%? You've given us your views in metals and financials. What else is looking interesting right now if the valuations were to come off?
As I said, I don't expect more than a big 5% to 10% correction, maximum 5%. The consumption stories look interesting. I highlighted Hindustan Unilever and Hero MotoCorp. I think even on the capex plays, it is time to accumulate L&T. If there's a major correction in the market, even now you can start looking at it. The stock has been correcting for some time. And also the other stock which probably that you could look at is in the IT space. We like HCL Tech, we like Infosys. Unfortunately, the overall rupee scenario is not helping those stocks, but we could look at buying the IT space in a dip. So clearly there are so this market is essentially been a high value market for three sectors, which are the financials, the consumption, and the autos. These have traded up over the last 3 to 4 years. Where valuations are elevated but not at peak levels would be in the infrastructure stories. And there we think that earnings need to surprise. The question being posed is when this earnings surprise comes through, we are saying near term in the consumption sector and next year for the infrastructure sector. So clearly L&T falls in that space, so you can look at L&T. The other stories that you could probably look at is also the refining stories. India has made a major move in terms of cutting subsidies, and in fact now we have a daily movement of oil prices. So we like IOCL, which has seen good volume growth. It's also had a bit of a price correction. So IOCL and the refining sector also look good. So there are still pockets where the valuations are not as elevated as in some of the other stocks which have done, other sectors which have done very well for the last 3 to 5 years.
Sandeep, why are FIs selling on a daily basis? Because the construct for emerging market is far more powerful and greater than developed markets. If at all, countries like India are on cusp of an economic recovery. Yet at a time when economic recovery is so visible and the macro positioning is excellent, the sell number in the month of July and August from FIs, they continue to, that is a big irritant.
True. We can't have everything always working in our favor. We can't have earnings growth coming through. We can't have perfect visibility on interest rates. We can't have perfect stability on the political side. We can't have global macroeconomic upward trajectory. We can't have buying both by domestic and by foreign. So in the broad picture, you cannot have every duck in a line always. And that's when you decide to pick up the gun and start shooting. So you have to take some risk, right? So you are pointing to an obvious risk, which has been the fund flow coming from the foreigners' side. Now, does that change anything meaningfully in terms of where India is positioned vis-a-vis the emerging sectors, emerging universe, emerging countries universe, or what is happening within India? Absolutely no. I think the FIs have been buyers for a very long period of time. They have been also buyers when there have been negative flows from domestic institutions, and they are right to take some profits. Does that mean that the FIs are walking out of India because they see something which no one else can see right now? Obviously not. They are humans like us. They see the same things, and they are in broad consensus that India is actually doing very well and is one of the top performers in the emerging market space, and that will continue. I think the thing to watch out for is what happens on domestic flows. I believe domestic flows are the story of the future, and that is something, if that changes, then I would be more worried.
Deep, appreciate your time and thank you for joining us.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.